All right, so we've got some really interesting stuff to dig into today.
Yeah, definitely.
You guys shared chapter 14 with us from Advanced Accounting, the 15th edition by Hoyle Schaefer and Dupnick.
Hmm.
And it's all about partnerships,
Partnerships, yeah.
how they get started, how they work, all that good stuff.
Right, the nuts and bolts.
Yeah, and I'll be honest with you.
Yeah.
This chapter's a beast.
It is.
It's packed with details, and it can feel a little overwhelming.
Dense.
Yes, very dense.
A lot to unpack.
So what we're going to try to do today is pull out the really important insights.
Yeah.
The things you absolutely need to know to understand how a partnership works.
Like the key takeaways.
From the very beginning all the way through how it might change and evolve over time.
Exactly. From that initial handshake to all the potential twists and turns down the road.
Ideally a little more than a handshake though, right?
For sure. Hopefully a lot more paperwork involved.
Yeah, definitely.
But yeah, this chapter really dives into the foundation, the legal side, the accounting, and even those big transitions a partnership might go through.
It's like the whole life cycle.
A whole life cycle.
Starting up running the business and what happens if things change.
Exactly. It's a complete picture.
So think of this deep dive as us doing the heavy lifting.
Yeah.
We're going to break it all down into those core principles.
Absolutely.
So whether you're thinking about teaming up with someone on a business idea, maybe you're already in a partnership.
Right.
Or even if you're just curious about how different business structures work.
Oh. Okay.
Why would someone choose a partnership in the first place?
Yeah, why not just go with a corporation?
Right. What are the advantages?
Well, the chapter points out a few really good reasons.
Okay.
One of the biggest is just how easy it is to form a partnership.
Oh, really?
Yeah. Believe it or not, a legally binding partnership can be formed with just an oral agreement.
Just like that.
A handshake, and you're in business.
Wow.
Now, the chapter definitely recommends getting everything in writing.
Right, of course.
But legally speaking, a verbal agreement can be enough.
So it's that simple.
It can be that simple.
Interesting.
Yeah, and if you compare that to incorporating,
Yeah.
which can be a real headache,
I've heard that.
it involves filing paperwork, tons of documentation, and it varies from state to state.
Oh, I bet that's a pain.
It can be a nightmare.
So for small businesses especially, I can see the appeal of a partnership.
Absolutely. It's all about speed and keeping those initial costs down.
Right. You just want to get started.
Exactly. Hit the ground running.
So a simple conversation could launch a business.
That's the beauty of it.
That's pretty amazing.
Yeah. But of course, there's more to it than just the legal setup.
Right. What about the money side of things?
Exactly.
How does a partnership handle taxes?
This is actually a huge advantage for partnerships.
Oh, really?
Yeah. The way income is treated is a major selling point.
Okay, I'm listening.
So in a partnership, all the profits and losses, they go directly to the individual partners.
Okay.
And then each partner reports their share on their personal income tax return.
So it's not like a separate corporate tax situation.
Exactly. That's the key difference.
Interesting.
This way you avoid what's called double taxation.
Double taxation. What's that?
It's what corporations have to deal with.
Okay.
They get taxed on their profits at the corporate level,
Mm-hmm.
and then the shareholders get taxed again when those profits are distributed as dividends.
Oh, wow. So it's like getting hit twice.
Exactly. And that could really eat into your earnings.
Yeah, I can see that being a problem.
But with a partnership, income is only taxed once at the individual partner level.
So that's a big plus for partnerships.
It's a huge plus for sure.
Now, what happens if the business isn't making a profit yet?
Good question.
How are those operating losses handled?
Well, that's another big difference between partnerships and corporations.
Okay, lay it on me.
If a partnership has operating losses, the partners can usually use those losses to offset their other personal income.
So they can reduce their overall tax bill.
Exactly. It provides an immediate tax benefit.
That's helpful, especially in those early years when a business might be struggling.
Exactly. It can really soften the blow.
But there's a catch, right?
There is one important condition.
Okay.
The partners have to have materially participated in the business.
Materially participated? What does that mean?
It means they need to be actively involved in the business,
Okay.
not just passive investors.
So they have to be really hands-on.
Pretty much, yeah.
That makes sense.
Now with corporations, it's a little different.
Okay.
Since a corporation is its own separate legal entity, it doesn't pass those losses directly through to the owners in the same way.
Oh, so the owners don't get to use those losses to offset their personal income.
Right, it's not as immediate.
So how do corporations handle losses then?
Well, the chapter mentions that they can carry back those net operating losses.
Carry back? What does it mean?
It means they can use those losses to recover taxes they paid in previous years.
Oh, that's interesting.
And if there are any losses left over, they can carry those forward
Okay.
and use them to reduce their taxes in future profitable years.
So it's more of a long-term strategy.
Exactly. It's about spreading out the impact of those losses over time.
So both structures have ways to deal with losses, but they work in different ways.
That's right.
Okay, so we've talked about some of the good things about partnerships.
The perks.
Yeah, the perks. But let's get real.
Okay.
What are the downsides?
Ah, yes, the potential pitfalls.
Yeah. What are the things people really need to be aware of before jumping into a partnership?
Well, the chapter is very clear about the biggest drawback.
Okay.
Unlimited liability.
Unlimited liability. Oh, that sounds scary.
It can be.
What does that mean exactly?
It means that each partner
Mm-hmm.
is personally responsible for all of the partnership's debts.
All of them.
Every last penny.
Yikes.
And this risk is even bigger because of something called mutual agency.
Mutual agency. Okay. I'm not familiar with that term.
So mutual agency basically means that any partner can act on behalf of the partnership.
So they can make decisions that affect the whole business,
Exactly. And they can enter into agreements and create liabilities for the partnership,
even without consulting the other partners?
as long as they're acting within the normal scope of the business, yes.
So one partner could make a bad decision,
Mm-hmm.
and all the partners would be on the hook for it.
That's the risk with unlimited liability.
That's a lot of responsibility.
It is, and it's why a lot of people choose other business structures that offer more protection.
Okay, so let's say my partner takes out a big loan for the business, and they
Okay.
don't even tell me about it.
Oh.
And then the business fails.
Mm-hmm.
Could the lenders come after my personal assets?
Unfortunately, yes. That's the risk you take with a general partnership.
So my house, my savings, everything could be at stake.
That's why it's so important to choose your partners carefully.
And to have a really solid partnership agreement?
Absolutely, you need to protect yourself legally.
Okay. Well, that's a sobering thought.
It is, but it's the reality of partnerships.
So to try and make things a bit more consistent,
Mm-hmm.
the chapter talks about the Uniform Partnership Act, or the UPA.
Right.
What is that all about?
The UPA is basically a set of rules for partnerships.
Okay.
It was created to make things more uniform across different states.
So it's like a common ground for partnership law.
Exactly. It was first proposed way back in 1914.
Wow, that's a long time ago.
Yeah. And it was revised in 1997.
Okay.
But almost every state has adopted some version of it.
So it's pretty much the standard.
It's the foundation for partnership law in most of the U.S.
So what does the UPA actually say about what a partnership is?
It defines a partnership as an association of two or more persons to carry on a business as co-owners for profit.
Okay, so it's pretty straightforward.
Yeah, two or more people working together to make money.
So we have this traditional partnership model
Right.
with its good and bad points.
Pros and cons.
The tax benefits are great,
Definitely.
but that unlimited liability is a big concern.
It's a major risk for sure.
So the chapter then talks about alternative legal forms.
Right.
What are those all about?
Well, they were created to address that issue of liability.
Okay, that makes sense.
A lot of people want the tax benefits of a partnership,
Mm-hmm.
but they don't want to risk their personal assets.
Right, who wants to lose their house because of a business deal gone wrong?
Nobody, that's why these alternative structures offer limited liability.
'Cause you get the best of both worlds.
Exactly. Tax efficiency and some peace of mind.
I like the sound of that.
So there are a few different options.
Okay.
One is a subchapter S corporation or an S corp.
Okay, I've heard of those.
So an S corp is kind of a hybrid.
A hybrid, how so?
Well, it still has the legal structure of a corporation,
Okay.
which means the owners have limited liability.
So their personal assets are protected.
Exactly.
Ugh.
But when it comes to taxes, it's treated like a partnership.
Oh, that's interesting.
Yeah, so the income and losses, they pass through directly to the shareholders.
And they report it on their personal tax return.
Exactly. So you avoid that double taxation we talked about earlier.
So it's a win-win.
Well, almost.
What's the catch?
There are some limitations with S corp.
Like what?
Well, you can only have a maximum of 100 shareholders.
Oh, okay.
And the shareholders have to be U.S. citizens or resident aliens.
And they can only be individuals, estates, certain types of trusts, or tax-exempt organizations.
Exactly. So it can limit your options a bit.
Gotcha. So there are some trade-offs.
There always are.
Okay, so S-Corp, one option. What else is out there?
Another option is a limited partnership or an LP.
Okay. How does that one work?
An LP is a bit different.
Okay.
It still has partnership taxation,
Mm-hmm.
but there are two types of partners.
Okay.
General partners and limited partners.
So what's the difference?
The general partners are the ones who manage the business,
Okay.
and they have unlimited liability.
So they're taking on more risk. What about the limited partners?
They're more like investors.
Okay.
They contribute capital, but they don't get involved in the day-to-day operations.
So they're more hands-off.
Exactly. And their liability is limited to the amount they invested.
So they're protected from major losses.
Exactly.
That sounds like a pretty good deal for the limited partners.
It can be a good way to invest without taking on too much risk.
Okay, so we have S-Corp and LPs. What other alternatives are there?
Well, there's also a limited liability partnership, or an LLP.
Okay, so I'm guessing that one's all about limiting liability.
You guessed it.
So how does it work?
It's similar to a general partnership,
Okay.
but the partners have more protection from liability.
In what way?
Well, they're still responsible for their own actions
Right.
and for the actions of anyone they supervise.
Makes sense.
But they're usually not liable for the mistakes of other partners.
Oh, that's a big difference.
It is, and that's why LLPs are popular among professionals like lawyers and accountants.
Yeah, I can see why they would want that extra layer of protection.
And absolutely nobody wants to be held responsible for their partner's malpractice.
Okay, so last but not least, we have the limited liability company, or the LLC.
Ah, yes, the LLC.
This one seems to be everywhere these days.
It's definitely become very popular.
So what makes it so special?
Well, for starters, it's treated as a partnership for tax purposes.
So pass-through taxation?
Exactly, no double taxation.
Nice.
And the owners, which are called members,
Members.
yes, they have limited liability.
So their personal assets are safe.
Generally speaking, yes.
So it's like the best of all worlds.
Pretty much it offers a great combination of benefits.
I can see why it's so popular.
It's a very attractive option for a lot of businesses.
Okay, so we've covered the different types of partnerships and their alternatives.
Wow.
Now let's talk about the accounting side of things.
Right.
The chapter talks about partnership capital accounts.
Yes, those are important.
So what are they exactly?
Basically, they're a way to track each partner's equity in the business.
Okay.
It's like their ownership stake.
So it shows how much each partner has invested.
Exactly. And it reflects their share of the partnership's net assets.
Based on the book value.
Right.
So these capital accounts don't necessarily show where the money came from originally.
No, not necessarily. It could have been cash, property, expertise, all sorts of things.
So the equity section of the balance sheet is just a list of these capital accounts.
That's right.
And they change over time as partners contribute more or withdraw money.
Exactly. It's like a running tally of each partner's investment.
So why are these capital accounts so important?
Well, they play a key role in a few different areas.
Okay.
First, they're often used to determine how profits and losses are allocated.
Right, because the more you invest, the more you stand to gain or lose.
Exactly.
What else?
They're also important when a partner leaves the partnership.
Okay.
Their capital account balance is usually used to calculate their final payout.
So that's like their exit package.
In a way,
Yeah.
yes.
And what about if the partnership has to be liquidated?
Then the capital account balances determine how the remaining assets are divided.
After all the debts are paid.
Exactly.
That's a pretty important piece of the puzzle.
It's crucial.
Now, the chapter really stresses the importance of having a written partnership agreement.
Oh, absolutely.
They call it the Articles of Partnership.
Right.
So what's the big deal about this document?
Well, even though a partnership can be formed verbally,
Mm-hmm.
having a written agreement is so much better.
In what way?
It prevents misunderstandings and disputes down the road.
It's like a rule book for the partnership.
Exactly. And it takes precedence over the default rules in the UPA.
So it's like your own customized set of rules.
Precisely.
Okay, so what are some of the things that should be included in this agreement?
Well, it should start with the basics.
Okay.
The names and addresses of each partner,
Mm-hmm.
the location of the business,
Okay.
and a description of what the business actually does.
So it's all about being clear from the start.
Exactly.
What else?
It also needs to outline the rights and responsibilities of each partner.
So who does what?
Exactly.
Okay.
And it needs to specify the initial contributions each partner is making,
How much money they're putting in.
right? And how any non-cash assets are valued.
Because it's not always just about cash, right?
Exactly.
What else?
One of the most important things is how profits and losses will be allocated.
We talked about that earlier.
Right. That needs to be spelled out very clearly.
And it should also cover how partners can withdraw money from the business.
Yes. How those draws are handled.
So it's a very detailed document.
It needs to be.
What else should be in there?
Well, it should also cover how new partners are admitted.
If the partnership decides to expand.
Right.
Okay.
And it should have a procedure for resolving disputes.
Because, let's face it, disagreements happen.
They do.
And what about if a partner dies?
It should address that too.
Okay.
Like if there are any life insurance provisions for the remaining partners to buy out the deceased partner's share.
That's
It helps to ensure a smooth transition.
And it should also cover what happens when a partner leaves the partnership.
Yes, whether they retire or withdraw for any other reason.
How their share is settled.
Exactly.
So this Articles of Partnership covers pretty much everything.
It's like the constitution of the partnership.
Okay, that makes sense.
It lays the groundwork for everything.
So let's talk about how those initial capital contributions are actually recorded.
Okay.
The chapter gives an example with two partners, Carter and Green.
Okay.
Carter puts in $50,000 in cash and Green invests $20,000.
Also in cash.
Yeah.
So the first thing you do is debit the cash account for the total amount.
Which is $70,000.
Right.
And then you credit each partner's capital account for their contribution.
Exactly. So Carter's capital account gets credited for $50,000.
Yeah.
And Green's gets credited for $20,000.
That's it. Simple enough.
Pretty straightforward when it's just cash.
Right. But what if a partner contributes something besides cash?
Ah, good question.
Like equipment or real estate?
Or even those intangible assets we talked about.
Like expertise or customer relationships.
Exactly. Those can be tricky.
So how do you handle those?
Well, any non-cash assets are recorded at their fair value.
Fair value, what does that mean?
It means what they're actually worth in the market at the time of the contribution.
Okay.
And for intangible assets, the chapter mentions two main methods.
Okay.
The bonus method and the goodwill method.
So what's the difference between those?
They're both ways to account for the value that a partner brings when it's not so easy to quantify.
Like when they bring something special to the table beyond just money or physical assets.
Exactly. It's about recognizing their unique contributions.
So these methods help to make sure everyone's contributions are fairly accounted for.
That's the idea.
Now, what about contributions that happen later on?
You mean after the partnership is already up and running?
Exactly.
Yeah, that happens all the time.
So how are those handled?
Well, they're basically treated the same way as initial contributions. The partner's capital account is increased by the fair value of whatever they contributed.
So if Carter decides to invest another $10,000 in cash later on, you would just credit their capital account for that amount.
Exactly. It's a simple adjustment.
Okay, now partners don't just put money into the business.
Sure.
They also take money out.
Those are called withdrawals or draws.
So how do you account for those?
Well, usually the Articles of Partnership will set some rules for withdrawals.
Like how much they can take out and when?
Exactly.
Okay.
So when a partner makes a withdrawal, you initially record it in a separate drawing account.
A drawing account, okay.
And then at the end of the year, you close out that drawing account by transferring the balance into the partner's capital account.
So it reduces their overall equity.
Exactly. It's like taking a portion of their investment back.
The chapter gives an example.
Right.
James withdraws $1,200 and Joyce withdraws $1,500.
So you would debit James's drawing account for $1,200.
And Joyce's for $1,500.
And Joyce's for $1,500. And then you credit the cash account for the total $2,700.
Okay.
And then at the end of the year, those drawing account balances are used to reduce their capital accounts.
So it all balances out in the end.
It does.
Okay, now let's talk about how the profits are divided up.
Ah, the all-important question.
It seems like it could be a source of tension.
It definitely can be.
So how does a partnership decide who gets what?
Well, at the end of each year, the partnership closes out its revenue and expenses.
And you get the net income or loss.
Right.
And then that amount needs to be allocated to each partner.
Exactly.
And how does that happen?
Well, ideally, it's all laid out in the Articles of Partnership.
So they decide up front how they're going to split the profits.
Exactly. It's much easier to do it that way.
But what if they don't specify a method?
Then the state partnership laws usually kick in.
And what do those laws say?
They usually say that the profits or losses are split equally among all the partners.
So everyone gets the same share.
Right.
But that might not always be fair.
You're right. It might not.
Because some partners might contribute more capital or put in more hours.
Exactly. That's why it's so important to have a clear agreement.
So what are some of the ways that partnerships can allocate income more fairly?
Well, the chapter mentions a few methods.
Okay.
One is to allow interest on the partner's capital balances.
Oh, like they're earning interest on the money they invested.
Right.
That makes sense.
Another method is to give salary allowances to partners who are actively working in the business.
So they're getting compensated for their time and effort.
Exactly.
And then after those allocations, any remaining profit or loss is divided based on a predetermined ratio.
Right, which could be equal or based on some other agreed upon percentage.
So it's a multi-step process.
It can be.
But it allows for a lot of flexibility.
Definitely. It's all about finding a system that works for everyone.
So you can really tailor the income allocation to the specific circumstances of the partnership.
Exactly.
Okay, so we've covered a lot of ground here. But there's one more big topic to discuss.
Partnership dissolution.
Yeah. What happens when things change?
Well, legally speaking, any change in the partners triggers a dissolution of the partnership.
Really, any change.
Yes, even something as simple as a new partner joining.
So the old partnership is dissolved.
Legally speaking, yes.
But the business itself can keep going.
Right, it's just a technicality.
Okay, so give me some examples of events that would trigger a dissolution.
Well, a partner could retire, a partner could pass away,
Right.
or a new partner could be admitted.
Okay, so those are all pretty major changes.
They are.
So what happens when a new partner joins?
Well, there are a couple ways it can happen.
Okay.
They can buy an existing partner's interest.
So they pay the partner directly.
Exactly.
And the money doesn't go to the partnership.
Right.
Okay.
Or they can contribute assets directly to the partnership.
So they're adding to the overall capital.
Right.
And how do you account for those different scenarios?
Well, the chapter talks about two main methods for handling the purchase of an existing interest.
Okay.
The book value approach and the goodwill approach.
What's the difference?
It has to do with how you value the partnership's assets.
Okay.
And when a new partner contributes assets directly, you just record the assets they contributed and create a new capital account for them.
So it's like starting fresh for that new partner.
In a way, yes.
Okay, so any change in the partners means a legal dissolution.
That's right.
But the chapter also makes a distinction between dissolution, termination, and liquidation.
Yes, those are important concepts.
So what's the difference?
Well, dissolution is just the legal restructuring of the partnership.
Okay.
Termination and liquidation are about the actual business ending.
So dissolution could be a step towards termination and liquidation.
Exactly.
Okay.
Termination is when the business stops operating.
And liquidation is when you sell off the assets, pay off the debts, and distribute any remaining funds.
Exactly.
So it's the final curtain.
The end of the show.
So what are some of the reasons a partnership might be terminated and liquidated?
Well, it could be because the partners can't agree on how to run the business.
It happens.
Or it could be because the business isn't profitable.
Right. You can't keep running a business that's losing money.
And sometimes it's because a key partner leaves and there's no one to take their place.
So there are a lot of different factors that can lead to the end of a partnership.
There are.
Finally, the chapter briefly mentions accounting for a partner's withdrawal. What are the main things to know about that?
Well, there are a few different methods for handling it.
Like what?
The bonus method, the goodwill method, and even hybrid methods.
So what's the goal of these methods?
The goal is to make sure that a parting partner gets their fair share.
And to adjust the capital accounts of the remaining partners.
Exactly.
So it's all about wrapping things up fairly and accurately.
Precisely.
Wow, we've covered so much in this deep dive.
We have.
From the very basics of what a partnership is, to the nitty-gritty of how they're formed, operated, and dissolved.
It's been a whirlwind tour of the partnership world.
We've talked about the pros and cons compared to corporations.
Right.
The importance of a solid partnership agreement.
Absolutely.
How to track capital contributions and withdrawals.
Yeah.
The different ways to allocate income.
And the implications of changes in the partnership structure.
It's a lot to take in.
It is.
But hopefully this deep dive has given you a clearer understanding of how partnerships work.
That's the goal.
So for our listeners out there, it's important to remember that forming a partnership is a big decision.
It is.
It's not something to enter into lightly.
Especially because of that potential for unlimited liability.
Right, that's a big one.
You could be putting your personal assets at risk.
So having open and honest conversations with potential partners is absolutely crucial.
Before you even think about shaking hands.
Exactly.
Talk about your expectations, your risk tolerance, your long-term goals.
And how you'll handle disagreements or changes down the road.
It's better to have those tough conversations up front.
So here's something to think about.
Okay.
Given how easy it is to form a partnership, but also how risky it can be.
Right.
What are the most important things to discuss with potential partners before you even consider an informal agreement?
What are the non-negotiables?
Yeah, what are the red flags?
And how do you plan to protect yourselves legally and financially?
It's all about being prepared.
and having a clear exit strategy in case things don't work out.
So think about those things carefully.
And do your due diligence.
Because choosing the right partners and setting up the right structure can make all the difference.
It can make or break your business.
Thanks for joining us on this deep dive.
It's been a pleasure.
We'll see you next time.
Until then.
Bye.